All right, so let's get into it. Let's start off with, so I talked about this last night on the Future Show, but for those that weren't there, I think it's an important topic to start off the discussion with, which is why is the stock market crashing? I know that's kind of vague and broad, but we talked about this last week. The quick synopsis on this, it was a theory that was first introduced by Chris. A lot of people have been thinking about it, and kind of the theory went viral over the past weekend. I mean, you had a lot of big counts kind of talking about this same argument. This post that I made on Twitter got about 6 million views, and I posted it on March 4th. So a lot of people have been thinking about it, been talking about it, and more people I'm seeing are at least somewhat saying this theory kind of makes sense. And the theory is as follows. We have $7 trillion of debt to refinance in 2025. Bond yields are currently high right now. The Trump administration does not want to finance their debt or refinance their debt at 4.5%. So in order to get rates to come down, we need J-POW to lower rates. J-POW's not lowering rates because inflation's not coming down. So how do you get rates to come down? As crazy as it sounds, you've got to kind of tank the markets. And I know a lot of people might not agree with this thesis, but I would encourage people to go a little bit more deeper into the sort of mechanisms of how this thesis is somewhat making sense based on the argument that the government's in a pickle right now. And the White House needs to be able to refinance their debt at a lower cost, and they need to get rates to come down, but they can't get rates to come down because inflation isn't coming down, and tariffs are definitely not going to get inflation to come down. But what can get the Fed the authority to lower rates to bring yields down is if the 10-year, the bond market, starts to price in a recession. Usually the bond market starts to go up if there are fears that inflation is going to be higher. And one could argue, well, why isn't the bond market at like 5 or 6% if inflation is going to be higher because of tariffs? Because you can look at a lot of different economic studies. The end result of tariffs has some inflationary impact. Well, the reason the 10-year is actually down from its high of January, I think 15th at 4.8%, is because now the bond market is starting to say, hey, we don't think NVIDIA is going to be the best deal this year. We don't think Meta is going to be the best deal. We don't think the broader U.S. economy is going to be as good. We're going to look at a lot of charts today that are kind of insinuating that same thing. You got Bank of America, a lot of Jefferies, JP Morgan, a lot of sell side analysts saying, hey, we're not that bullish U.S. equities anymore. And so we'll talk about all those different individual pieces of analysis. But the core argument is the bond market is feeling the volatility caused by tariffs is leading to the stock market not being the choice of allocation of capital, which means what do? They buy bonds because that's safer. If you buy bonds, yields come down. And if yields come down, this is what the Trump administration wants. They want a growth scare, maybe not an actual recession, which we'll talk about, but they want the fear of a recession, which is, I know it's crazy and I know it's conspiratorial, but if you I've read a lot of articles this weekend kind of echoing the same exact argument. And we heard from some pretty well-known analysts making the same point as well, that if you create enough fear in the markets, even if you don't actually have a growth scare, the fear of it in and of itself is enough to get bond yields to come down as people start buying bonds, which forces the Fed's hand at cutting rates, which is what the Trump administration wants. Even if the stock market suffers in the mean term, rates come down, which is all that matters to the administration. And if that happens, then I think the volatility that we're seeing right now could continue to we could continue to see a lot more of that volatility. This is Tom Lee basically echoing that thesis on a podcast he did over the weekend.
Well, since you brought that up, one of the charts that went around this week, including me spreading it, but like a lot of people were sharing that GDP Now chart. And I know there's some funkiness about the turnover from January to February with some of the data. Let's not take this as an actual forecast, but that's a pretty extreme drop. We went from a 2.8% GDP Now reading from the Atlanta Fed to -4.
Yeah.
Outside of the pandemic, can you recall a drop-off of that magnitude? Even if there are all these nuanced reasons for why it's data related and not, or it's a quirk of how they collect the data, it still seems extreme.
Yeah, it's big. I mean, it does paint a picture that economic momentum has slowed. So,
or the brakes have slammed on. It looks like to me. Okay.
That's right. At a time when we know even businesses are saying that they've gotten cautious because they don't know what to do with tariffs. So that's why if you look at the markets, they're pricing in a growth slowdown from tariffs, not inflation. And so the Fed, I think the White House wants the Fed to kind of get off neutral. And I think it's increasing looking like the Fed is behind, actually.
So Tom Lee says right there, the White House wants the Fed to get off neutral. How do you do that? You can't just get the Fed to get off neutral unless you actually make the Fed feel like there's pain in the economy. Because the Fed, this is the number one thing to understand about this thesis. The Fed is not going to cut rates based on inflation coming down because inflation's not coming down, right? And the Trump administration knows this, and they know tariffs are probably inflationary. So the only way you get the Fed to actually decide to cut rates is by making them feel that there is an actual slowdown in the economy.
So if they really want the 10-year Treasury to fall, the yields, keep going. Because that yield is not pricing in inflation anymore. Now it's pricing in recession.
Yeah,
we're starting to.
That's right. And then and the only difference is nobody wants to even get within, 10 yards, a touchdown of stall speed, because it's just too easy to slip into a recession.
So Tom Lee's argument is like, hey, this theory makes sense, but the problem is if we get too close to the sun, we can lead to a recession. And that is the risk. That is this sort of dangerous game that Trump is playing right here, which is that if we get too close to forcing the Fed's hand and actually causing a growth scare that becomes like a growth slowdown, we end up getting a recession. Now, one of the reasons I think Tom Lee is still bullish and I'm still bullish is because although Trump is trying to get the Fed to lower rates by causing this fear, every time the tariffs need to get implemented, which would create the actual slowdown of growth, right? Like, because that's what everyone is so upset about, that tariffs are going to slow down growth, create more inflation, create more job losses because people are going to cut down labor costs to be able to save on their unit economics. Every time we get close to implementing those tariffs, we get a delay. We get a 1 month extension of the tariffs. And so it's this weird game of cat and mouse, which again, I don't know what the end result of it is going to be, but it's almost like Trump wants the market to get scared to then buy bonds to get the Fed to cut rates. But when it's time to actually like make the market scared by actually implementing the policies that are so growth scary, they don't get implemented. They end up getting delayed. And the reason I think they're getting delayed is because if you look at what happened last term in 2018, they ended up getting to a deal, right? Now, 2018 was very volatile and it sucked for the stock market. But in 2019, Jay Powell started cutting a lot of rates. And Jay Powell started cutting a lot of rates. That was obviously good for the stock market. Stock market rebounded, and then they ended up getting a deal with China, and the trade war kind of ended from there. So if they go the same route at this point, we're going to kind of see how this ends up playing out. And remember, this is a theory. This doesn't have to be the correct argument for why this is happening. This is just based on all the research I've been doing. This is what it seems like. I'm not defending this theory. I'm not saying it's a good theory. I'm not saying it's a bad theory. You could also have a lot of other arguments for why Trump is doing this that are just based in ego, right? That he thinks tariffs are the best, and that ego is enough to create a stock market collapse because he cares so much about implementing his tariff thesis. Like, you could have whatever reason you want. The point is, I think we can't be oblivious to the fact that he is quite literally telling us to his face, he does not care about the market. He cares about rates coming down. And quite literally, he said that on Fox Business on Sunday.
But you may get it again with these tariffs, right? I mean, one CEO said to me, my input costs have already started to go up.
Well,
I'm going to have to raise prices.
In the meantime, guess what? Interest rates are down for the last 3-4 days at good levels. I mean,
that's the first thing he says on a question about, hey, private CEOs are telling me input costs are going up because of the tariffs, which are going to affect the consumer. He diverts the entire question to, well, interest rates. I mean, if that's not the most obvious telltale of where his priorities are, then I don't know what is.
Input costs have already stared to go up. I'm going to have to raise prices.
In the meantime, guess what? Interest rates are down for the last 3-4 days at good levels. I mean, when you add interest rates, you're talking about it's gone down. I've been saying, let's get interest rates down. Nobody ever gets rich when the interest rates are high because people can't borrow money. Interest rates are going down. You know what else is going down? What have I been trying to get down?
Oil.
Energy. Energy's going down. I'd love to see energy go down. Energy is really what caused it. They screwed up my energy. I had the most energy, and they screwed it up. Then they went back to it. It was going through the roof. They went back to some drilling, but it was gone. It was hopeless. It was lost. But energy's gone down and interest rates have gone up over the last week. That's a big thing. I love that.
But you may get it again.
Sorry, I was muted. His last sentence right there is like, I love that, right? I think there is an argument that because he's so intense around the concept of getting interest rates to come down. Notice his logic right there. His logic is, hey, no one gets rich when interest rates come down, because mortgage rates, financing a car, yada yada, right? Like you can't really do anything when rates are super high. So if people get rich, or people have the ability to even, survive in an economy when we have low interest rates, when we have high interest rates, it's very difficult. And so on a question on tariffs and the implication for the consumer, and obviously the implication on the stock market, Trump's analysis goes back to interest rates. And I just don't think that can be ignored. I think it's very difficult to ignore that as an investor, because if this is what the president of the United States is instructing his administration to engage in, which is policies that, or at least the resemblance of policies that make the Fed want to cut rates, then I think we have to take him seriously. Yeah, there are some problems with X. Mine isn't loading as well. For those that are having issues with X, mine was being weird with the loading. I thought it was a Wi-Fi thing, but I think it's an X thing right now. So if you're having problem loading your posts on X, mine is not also loading as well. So yeah, that might be a thing that everyone is dealing with right now. So that is my thesis on it, or that is my analysis of what Trump's thesis is. And again, let me say this over and over again. I don't know if this is correct. I don't know if this is true. I don't know if this is real. This is just when you put the data together, this is what it looks like. And if anyone else has a theory on why the administration is engaging in this way, I would love to hear it. But from all the data that I've compiled together, and based on listening to Bessent, listening to Howard Lutnick, listening to Trump talk, this is what they're trying to do. You can disagree with it. You don't have to agree with this theory. You don't have to agree with what Trump is doing right here. But this is one theory of many theories that are out there. This is the one that I think has some of the most data to back it up, at least based on what Tom Lee is saying, what Josh Brown is saying, what some of these people in the administration are saying for how the administration is actually thinking of rates right now. Yes, but the 10-year rate is at the same level as mid-December. I agree, and that 10-year has to come down. So this is my point. Like, this is a dangerous game that Trump is playing, because if the 10-year does not come down aggressively and he doesn't get rates to come down, then this is not going to work, right? So the game he's playing right here, I think, is a very, I don't know if this game is going to work, but I do think there's a world in which it could work. If it doesn't work, then yeah, like this 10-year is going to be in a tough situation. The market's going to be in a tough situation. Also, what doesn't help him is a good labor market. The ironic thing about this is he wants a growth slowdown to get rates to come down, which again, in that interview, it's very important to read between the lines. When he's asked about the nature of tariffs and the implication on the consumer, he says, the consumer cares about low rates, not tariffs. It's like, well, the consumer is definitely implicated by tariffs, but he's like, no, it's not about tariffs. It's about rates coming down. And if the tariffs are what cause rates to come down, that's where he gets excited about this. So if rates don't come down, that's when we have an actual issue. And the problem is the non-farm payroll report that we got on Friday was really good, 150,000 jobs. The market wanted 160, but like 150 is not bad. And Trump took credit for that, right? He did this whole press conference in the Oval Office where he was talking about why he's revitalizing the private industry, yada, yada. If we keep getting good jobs reports, we are not going to get the probabilities of getting a rate cut to increase as dramatically as Trump wants it to increase. And how do we know that? Well, if we look at the probabilities for the month of May, it was at 50% before the non-farm payroll report. Now it's at 37 because that report was actually pretty good. And so I think the strategy that Trump could be deploying is that he wants short-term pain for long-term gain. I mean, I said this last night, but now in hindsight, it seems kind of obvious when Jim Cramer on the floor of the New York Stock Exchange asked him, hey, like, should people buy stocks? He was like, well, there could always be dips. And, it's interesting that he said that. It's like almost they've been thinking about this for a while, that, hey, there's going to be some short-term pain in the markets to be able to get rates to come down, but it's inevitably what they have to do if they want to go this route. Is it the right route? I don't know. We're going to find out in the coming months. But it could be one of the routes that Trump is taking. Regardless, we're going to find out over the coming weeks how this ends up playing out. This is one theory that's going around, and we will see if it ends up working. Another theory that is going around is that Doge is going to help get that 10-year to come down because we are cutting more on the expense side. Here's what Trump had to say about Doge over the weekend.
You just said, what he's done is unbelievable. Now, you could then add some, but what about he's found hundreds of billions of dollars worth of fake contracts. And I read them, just a tiny portion of them the other night. Transgender surgery on mice. The money they're spending on all of this stuff, the whole thing's a scam. And you'll find ultimately that the money that they sent comes back to a lot of the people that made those deals. Okay, you're going to find that. what he's also done is made people realize how many people should be cut. Because normally you go in and you say, all right, cut 4% of your workforce. He said cut 50%, 60%, 70%. That's a big thing. Now, he's done a great job. You just said, what he's done is unbelievable.
So there you have Trump basically saying that Doge is the next sort of solution on the sell side for the 10-year that can get this thing to come down. And I mean, look, Doge has been making some progress. We're going to see if it can actually make the type of progress that Elon wants it to make. But if they can succeed with Doge, to some respect, getting government spending to come down, that's another thing or another reason you could say for why the 10-year could maybe take a little bit of a breather. I just think you're going to need more to get the 10-year to come down than Doge, right? Like you're going to need real fears in the economy again for people to pick bonds over Nvidia. And in order to make that happen, again, people have to be really afraid of what's going on in the economy. Here's what Trump said about tariffs last night as well on Air Force One.
It's going to make our country rich again. We have many companies, as you know, auto companies are opening up plants now. We've had 4 or 5 announced already, but many more are coming. And we're basically going to take back the money, or a lot of the money that we've given away over many decades. We've lost our jobs. We've lost our factories. We've lost 90,000 factories since the beginning of NAFTA. It's not that long ago. 90,000 factories. Think of that. And we're going to get them back. And they're coming back. And they're coming back in records. Look at what happened with the big chip company, the biggest in the world. By far the most powerful chip company in the world, from Taiwan. And they're going in with $200 billion of money, and they're going to build something that's going to give us 35-40% of the chip market in one company. No, it's going to bring it back, and I think it's going to make us bring us to a level that we've never had before.
Again, the Trump administration is very headfast on engaging in this strategy, and we are going to find out if it works or if it doesn't work. But I think we have to take the administration at their word in terms of how they are thinking about tariffs. If they are serious about deploying them, even though every time they get ready to deploy them, they end up extending them. It's the strategy that they want to go for. Now, what's also really important about this as well is that the aluminum and steel tariffs, they're going into effect in 2 days. So those are 25% tariffs. Those are not getting delayed from my understanding. Mexico and Canada tariffs were delayed until April 2nd, but aluminum and steel definitely will go into effect in the next 2 days. And so when those do go into effect, we are going to see the impact of those, which will be the first kind of real tariffs in the stock market that end up going into effect based on what the Trump administration had to say. Here's one more piece of coverage in terms of what Trump said about the stock market last week, and then we will get into a couple other headlines that we got going on right now.
Speaking about the recent stock market volatility, Eamon Javers joins us now with more. Hey, Eamon.
Yeah, good morning, Joe. In an interview with Fox News yesterday, President Trump addressed last week's stock market turmoil caused by confusion around his tariff agenda. In one exchange, the president suggested that calls by the business community for clarity on that policy are just a talking point for the big globalists. Here's what he said.
I think that they say that. It sounds good to say. But for years, the globalists, the big globalists, have been ripping off the United States.
And asked if he's okay with the stock market going down, the president dismissed the idea of short-term focusing on the stock market.
What I have to do is build a strong country. You can't really watch the stock market. If you look at China, they have a 100-year perspective. We have a quarter. We go by quarters.
That's true.
And you can't go by that.
So even listen to what Trump says from that perspective, right? When asked about the stock market, instead of saying that, we'll look at it here and there, he's saying, look at China. They have a 100-year perspective. We have a quarter by quarter perspective. You don't say that if you think quarter by quarter is going to be good. You only say that if you think, all right, there's going to be some pain in the short term. We got to get ready for the long-term gain. And that's kind of how you get out of that thesis. So I think we got to take him at his word. I mean, if he's saying, hey, short term, like it's going to be bad. Even Scott Bessent said we're going to go through a quote unquote detox period, which to me also means that the government is going to stop spending. A lot of the GDP, or 30% of GDP growth, is government spending. If that 30% starts to slow down to, 20%, and Trump says, well, look at China, they think in centuries, we think in quarters. I mean, it's again, if you read between the lines, it's pretty obvious. He's saying, don't expect any short-term momentum. You should be expecting some short-term pain versus long-term momentum. At least that's how I'm reading and interpreting what ultimately he's trying to say. And that's what we're getting. We're getting some short-term pain as a result of the policies that he is deploying right now, but he believes those policies will be more effective over the long term. Bitcoin right here is up from 79,000. It was at over the weekend. Now it's at 82.8. It was at 97 last week. The Bitcoin Strategic Reserve was announced. That reserve was kind of a sell the news event. Bitcoin right now at 82. It is up on the day, which is nice. It was at 79 last night. So nice to see Bitcoin getting a little bit of momentum. But the drop from, I think, 87 to 82 over the weekend, that is why Robinhood's down 7%. That's why CleanSpark's down how much? 3%. Coinbase is down 5%, 5.13%. And MicroStrategy also is down 5.63%, mainly because of Bitcoin kind of selling off on this crypto reserve news. And, you know, we'll see where Bitcoin ends up playing out over the coming weeks. But we're red. We are definitely still red. Is the market going to stay this way? Yes. So now here's my kind of overall synopsis on what's going on. Not synonymous, like I said last night, but synopsis. My synopsis is that at the end of the day, the S&P 500 is still only down 2% year to date. So with all the hoopla that's been going on, with all the volatility that's been going on, we are still barely down year to date. Now that means two things. The good thing is that means that, hey, with everything that's crazy that's happened, we're only down 2%. That's like really good, right? The bad thing is with everything going on, and if we're only down 2%, then we've got a lot further down to go. So it's one or the other, right? It's either going to kind of normalize here at the 200-day moving average, which would be very good for this market, and we would be able to kind of form a base around here, or we lose the 200-day and we're headed much lower. My opinion here is that, I mean, could you sell right now and make a ton of money shorting the market if the market falls another 10, 20%? Sure. Like that is a strategy. I just don't think that's the strategy I would deploy. I think the time to really go short and sell was 3 weeks ago. Now, why didn't a lot of people do it? Well, a lot of people aren't professional hedge fund managers that know exactly when the top and the bottom is. Most people that run hedge funds don't know when the top and the bottom is. So I don't think I would feel bad for not selling at the top and deciding to go short. But now, like you know, Robinhood's down almost 40% from the highs. Is that the time to sell? Not in my opinion. Could it go lower? Of course. But is that the time to sell? Not really. Is that the time to go short Robinhood? Not really. Unless you're expecting a 2022 type of year. Right? If you expect a 2022 type of year, then yeah, it's aggressive. But if you're not expecting that type of year, then I don't think that's as big of a deal. Stata says right here, says we shouldn't look at the year-to-date decline, but as a decline from all-time high. Well, I agree. So the all-time high decline is already 7% on the S&P as well. The reason I'm using year-to-date is because we measure the S&P in terms of aggregate performance per year. And so that all-time high, the reason I'm not a fan of using that metric is because we probably weren't supposed to get there. Right? Like Palantir at 125, Palantir was almost $300 billion in market cap. It was almost exceeding Salesforce's market cap. We probably weren't supposed to be there. That was pure momentum. Same thing with Hood, even though I think you can make a case for why Hood at 65 was actually a reasonable valuation. Probably wasn't supposed to get there that quick within, 4 weeks of the new year starting. So I think a lot of the all-time highs we saw on the market as well were aggressive momentum-based all-time highs that we probably weren't supposed to see. It was fueling off that 2024 momentum. And now we've normalized. We are down year to date on the S&P, only 2%. I mean, Robinhood and Palantir are still up year to date, right? Even though they're down from their highs. And so to me, from that perspective, it's still not the time to go short or not the time to get aggressively to the point where you start where you want to start selling everything. My strategy right here is writing covered calls. I mean, I think that's also pretty simple. Like the beautiful, I talked about this last night, but the thing people don't talk about when you buy puts is that you need the asset you're buying a put on. So technically, like you're going short on that name, right? You need that name to fall. You need it to actually go down. So if I write a covered call on SoFi for $15, I don't need SoFi to do anything but just not go above 15. And if it does go above 15, okay, I sell my shares and hopefully my average is above 15. My adjusted cost basis is below 15, and then I make a profit and I keep the premium. On puts, if I write a put on SoFi when it's $12.50, I need SoFi to materially go down in order for my put to be profitable. If it doesn't go down, if it just stays flat, which is really what has been happening, and this is my point about maybe now's not the time to go short because SoFi already is down from 16 to 12. Palantir is already down from 125 to 80. So for it to go down again, which is the whole purpose of buying puts as a hedge, you actually need the asset to go down. What if it just stays flat? What if it consolidates? What if we're in this ping pong market where it goes down a little bit, then it comes up a little bit? Your puts don't print, but what does print is your covered calls. Because as long as the stock doesn't go up, your covered call continues to gain momentum. If the covered call, if stocks actually go up, then your put is a hedge because you're okay with losing that money, that premium you paid because your entire portfolio is going up. But if you're buying puts to make money on it and the stocks don't go down, I think the better strategy right there is covered calls instead. Especially when there are so many stocks, NVIDIA, SoFi, Robinhood, Palantir, where the premiums are still incredible. I mean, Tesla, dude, there are people buying freaking $500 calls expiring in 2 months on Tesla. There are those people out there that will pay a premium for those strikes. So I think that's the strategy that I would be deploying right here. It's not really selling everything and going into cash. I mean, if you want to high class your portfolio and get rid of some junk, take some early losses, I don't think that's the biggest deal in the world, especially if you're a little bit afraid of the volatility and how much worse it can get. But I think now that we're already down a ton off all-time highs year to date, we're still not down that much, which means we could go lower, but is it that much lower to create this monumental 2022 type of year? I don't think so, even with Trump deploying whatever strategy he's deploying around tariffs. So we're going to find out. We're going to find out over the coming months, but that is kind of the strategy that I'm thinking of right now. Admit my clients don't really give a shit. We are down 2% year to date. They care about how much their accounts are down from all-time high. I would tell your clients to stop being, I'm not going to use that word, but I would tell them to stop bitching. That's what I would tell them to do. I mean, look, if your clients didn't sell Palantir at 125 or Tesla at 487, I mean, they really can't be complaining, dude. Like you cannot complain if Palantir or Tesla fall 50% from all-time highs and you didn't take profits at all-time highs. I mean, also, if you're managing their money and you didn't sell for them, then you've got to come up with a hell of a reason for why you didn't sell at all-time highs. And one of the reasons could be, well, let's be long-term investors. But they're probably not paying you to just be long-term investors. They're probably paying you to actively manage their money. So if you're actively managing their money and you didn't take profits at the top and now they're bitching about how they're down 50% from the top, who do they have to complain at? The person who's probably managing their money, right? So, I mean, like, to me, fund managers are in the same position that a lot of us are in, which is that they didn't sell at the very top, because most people don't know how to sell at the top. And most people can't recognize that Tesla at 487 is probably not going to 600. It's probably going back to 250. I didn't think it was going back to 250. I was in the camp of like, okay, momentum's there. Tesla 487. Let's see if we can go higher. But if ultra high net worth individuals are upset that they didn't take profits at the very top of the market, welcome to the stock market. Like, most people don't know how to do that. Most fund managers aren't worth any of their percentage allocation fees because they don't actually know how to manage a portfolio. They're just as good as you or me, right? Even if they have some fancy FINRA license to manage money. So I don't think anyone should be complaining that Palantir is at $80 when we are trading at 89 times price to sales. Even Tesla is still trading at some pretty aggressive multiples, which is not a growth stock anymore. Tesla did not grow last quarter. And it looks like in Q1, they're probably not going to grow again because their automotive sales don't look that nice right now, down 4% of the pre-markets. If you didn't sell at 487, I mean, who else do you have to blame? Blaming Elon and Trump about not selling at the top, to me, is a loser mentality. Like, and I know it's fun to have someone to blame, but if you didn't sell MicroStrategy at 540 because you thought it was going to 1,000 because Bitcoin was going to 1 million, I'm sorry, but that's on you. Like, that's not that's not on anyone else, you know? And it sucks. I get it. It sucks. But at some point we have to take personal accountability as well. That's why I'm not bitching about not selling Robinhood at 65, because I never was going to sell it at 65. Like, my mentality, you know, when I say I'm not selling, I'm not selling. I didn't sell Palantir at 25. Why? I bought Palantir at 103. I know it was a little bit of a fun, just like, let's celebrate that we're at 100. But the reason I have not sold a single share of those two companies is because I believe in them for the long term, and I have to deal with the volatility of, and I mean, I dealt with the volatility for Palantir when it was at $6, when Robinhood was stuck at like $10. Like, I've been through that, right? And so this is not any different. This is just continue to hold on to the long term and see how it plays out. But if you're going to actively manage money, you've got to be able to sell some portion of assets at the top. It's just really hard to do that. But that's why it's also really hard to manage money. And so, I don't know. People complaining about that to me is stupid. Like, it's the market. Things go up, things go down, things get aggressively expensive. If you don't take profits right there, you have no one to blame but yourself at that point. But again, I don't think people should be blaming themselves because it's really hard to do. And because it's really hard to do, there are certain sort of mental tricks you have to deploy of just remembering, like, you're a human being and it's not always easy to time the exact top and bottom.